Start all
All righty, guys.
and then roll the intro. Oops.
There we go. A little bit of a glitch at the start there. Welcome, everybody. Thursday afternoon. You are back live. We are here, the Minds of Markets live broadcast. Yes, I am here live down on the SIBO trading floor in the S&P 500 option pit. I will tell you so far today, it's been very muted trade, very quiet. But in the last 15, 20 minutes or so, as we've seen S&Ps go from pretty much unchanged where they were all day to now, well, we're down 11 points right now, which is not really a big deal, but we've heard the volume kind of tick up a few decibels here. People getting maybe a little bit more anxious to make sure that their positions are where they want to be at the end of the day today, going into tomorrow's big jobs number. That's what the entire focus of the market is right now. And this has been a super big week for eco data. And what is the Fed going to do? We've got a lot to talk about with that. Let me give you a quick update right now on what the market is doing, though. Right now, S&Ps are down about 11 points, 53, 54. Very, very light volume. Just about 700,000 S&P futures have traded. We got about 1.5 million so far, which is an average daily volume. So pretty light volume. Same in the triple Qs, same in SPY. Really light volume today. Again, probably quite a bit of anxiety or just people waiting for that number to come out tomorrow. And that number is going to be super, super important, especially after what's happened in the last 2 days, one with Canada and one with the bank in Europe with the ECB, both lowering rates. So we're going to talk about that in a moment here, but tomorrow's non-farm payrolls number is going to be very, very important. All right. So if you guys have any questions, anybody, wants to know anything, what's going on either in the markets, if you have a specific question about something, please throw it in the chat, throw it in the YouTube chat, throw it in Facebook and X. We're on live today, so this is a new addition today, which we're very happy about. Let's talk about the jobs for tomorrow and why it's so important. So yesterday we got a payrolls number out of ADP. Okay, that kind of gives an advanced warning, an advanced metric ahead of the monthly non-farm payrolls number. Now, the ADP number, that came in much lighter than expected. Now, that's something that the Fed has wanted to see because the job market, the labor market has been extremely, extremely tight. That's been their key as to really what they're focusing on to see if they're going to be able to lower rates at some point. They really wanted to see that labor market cool down. ADP number that came in yesterday suggests that. Now, that's 1 month. We can't just look at one number. We can't just look at 1 month and say, all right, here we are. But what I want to bring up here, guys, and let me go to my screen here, because what I want to bring up is this chart right here. This chart right here is a comparison of looking at ADP and tomorrow's number, which is called NFP, non-farm payrolls. ADP has not been a good indicator of what the non-farm payroll report has been. It really hasn't been. So, you know, take it for what it's worth, but just because the ADP number came in really light tomorrow or yesterday does not mean NFP is going to come in light as well. It's a pretty bad track record, quite frankly. Recently, there's been some unpredictable volatility out of the ADP, and you know what? It's an indicator. It is an indicator of what may happen tomorrow. Now, again, why is this so important for the market of what the non-farm payrolls are? Well, again, it's what the government or it's what the Fed wants to see what's happening in the labor market. If there's a slowdown, that's what they're looking for. Now, we always have to be careful that, don't always want to get what you wish for, right? Because some of the eco data that we've seen over the last couple of weeks is suggesting that the economy is slowing down, which is what the Fed wants to see, and in order for them to be able to cut rates. However, if we continue slowing down and if the labor market starts to crack, well, all of a sudden that news that they're looking for, which could be suggestive of an economy that is, pulling back or the R word recession, the market may not love that. So, it's that careful balancing act, which personally I think Powell and the Fed have backed themselves into a corner, and they're kind of keeping their fingers crossed for this number tomorrow. I think they want to see a number that is really in line with expectations, maybe slightly lower. So we'll see what happens. Now, what is reflective of this number tomorrow, if we look at SPX implied volatility, and this is where I'm standing here. I'm standing right here in the S&P 500 pit. If we look at, I'm going to pull this up here, what implied vol for tomorrow's expiration is. Okay, S&P's trading 53.44. If we look right here, at the money implied vol for tomorrow is slightly under 17%. That is elevated quite a bit because if we go out to Monday, and if we look at Monday's implied vol, Monday in the SPX at the money implied vol drops to about 10%. So you can see the additional angst, the additional, I don't want to say fear, but expectation of a bigger move in the market tomorrow, just like we would see in a stock that has earnings coming up. What do we normally see implied volatility there? We see implied volatility rise into earnings, and that's all because of why, everybody. Why do we, see the VIX rise, or why do we see volatility rise in any environment? Uncertainty. Uncertainty. So that's what it is. And it's the uncertainty of tomorrow. I guarantee you guys, once that number comes out tomorrow morning, we open up. I don't care if that number is good, bad, and different. If S&Ps are up 20, down 20, unchanged, we are going to see a volatility crush in the SPX tomorrow because that uncertainty is gone. All right. So S&Ps right now, as I've been talking for the last 7-8 minutes or so, pretty much unchanged. One thing which is really cool, where I'm standing right here, the big board is right in front of me here, so I can see every trade that's happening. So if there's something that goes down really big here, I can let you know what it is, and I'll pan across the room also so you can see the entire pit. One thing that a couple people had actually asked me to talk about, which is very, very relevant for what's going in the marketplace right now, what's happening with the bond market and how do prices and interest rates correlate to one another? Well, the bond that most people follow, that they key in on, is the 10-year. The 10-year is really what mortgages are based off of, your car loans are based off of. And if we look at the marketplace, where were we last week? We saw the 10-year rising again. We saw the 10-year rising back up above 4.6%. It had been as high as 470, 480 just about a month or so ago, came all the way back down. It was rising last week. Now, with the softer economic data that we have seen over the last week, especially this week, interest rates have come off. Interest rates, especially in the 10-year, are down to about 432 or so, 433. That's significant. That is a huge move from the 460 plus we were at just last week. I would think we're going to get a big move tomorrow in rates depending on this number. If we come in with a very soft number tomorrow, lower than expectations, we will probably see a continuation of rates coming down. Now, one thing that people are confused about, quite frankly, a lot, is the relationship between interest rates and the price of bonds. Okay, a lot of people may know that they have an inverted relationship; they're inverse to one another, but it's kind of hard to understand, quite frankly. It took me, way back when, it took me a long time to really understand that analogy of this inverse relationship. So let me explain it to you this way. Okay, The government, how do they raise money? The government raises money by selling bonds, and people buy them and they pay the government money. And so when they're selling bonds, people have to be bid for them. If there are no bids, or if, let's look at supply and demand, if the demand in the marketplace is not up to the supply of what the government has in selling bonds, what has to happen? Well, they have to either make the price of the bond cheaper or they have to raise the rate of return. Okay, so think of it that way. So if nobody wants to buy your product, you've got to get a better return or you've got to pay less. So as bond prices come down, yields, returns move higher. So what happened during, post COVID? When we saw interest rates basically down to zero, right? What was the government doing at that time? Well, they were able to sell bonds. People wanted them because of uncertainty. People were willing to accept at the time, because of the uncertainty in the world, people were willing to accept buying a bond for a year, 5 years, 10 years, 30 years, whatever it was, and locking it in at minimal interest rates because they wanted safety. They wanted to park their money somewhere where, nobody knew if this was, the end of the markets, the end of the world. They wanted safety. So it was very easy for the government to sell bonds at a very, very low interest rate. Okay, now fast forward a couple years to where we are now, and what started a year and a half ago or so, as we came out of COVID, we came out of the pandemic, and everybody got back to normal, and everybody wanted to now spend money, right? Do the things that we couldn't do during the pandemic. Okay, that's what really has caused inflation. And it's not just a US thing, it's obviously a global thing, but the economy heated up so quickly, so quickly. Well, what does the Fed do to combat that? What does the Fed do to make interest rates higher? Because remember, back just, during COVID, people were able to borrow money basically at zero interest rate. How many of you, locked in your mortgages if you were able to refinance 3%, 3.25%, right? Because, basically the government was giving away money at that time. Well, that was to spur the economy. That was to spur people spending. But we got so hot, people spent so much, government has to pull that back, or the Fed has to pull that back. So they can reduce their balance sheet, the amount of bonds that they hold, or what happens as rates go higher, yields go higher, bond prices go down. So now all of a sudden, the same bonds that the government was really, able to sell at zero, 0.5%, 1%, whatever it was years ago, now that we're back to a normal society, I guess if you want to call this normal, I'm not so sure we live in a normal society anymore, but now that the market dynamics are back to normal, um, nobody wants to buy a bond with only a 1% return or a 2% return or a 3% return, 4%. You get the drift here. So the government has to keep raising the rate, lowering the price of the bonds. So does that make sense to everybody? The inverse relationship between bond prices and yields? It really comes down to supply and demand, everybody. That's really what it comes down to. All right, let me give you a quick market snapshot here. S&P's really still in the same place. They rallied 2 points. They're down 9.5 right now. Volume, again, really, really atrocious. Not even 750,000 futures contracts. Again, average daily volume is about 1.5 million. I can see a lot of trade going on, small trade going on in a lot of the zero deets expiring today. A lot of rolling. I see some rolls, people selling out of tomorrow's expiring positions on the 7th and rolling out to either the 10th on Monday or the 14th next week. Again, if something big comes up here, I will talk about it. Now, let's talk about where the market thinks rates are going. Okay, and let me pull up a different screen here for everybody. Hopefully, I'm going to get the right one. All right, we don't need that NFP one anymore. What we need is this. Now, this is what's called the CME FedWatch tool. This is a live market prediction of where rates are going to be. This is based on where treasuries are trading at the time. So the next Fed meeting is right here. It's June 12th. It's next week. Okay. Right now, the current target rate that the Fed is set at is 5.25 to 5.5. You can see right here, there is basically a 100% probability. Nothing's 100%, so it's 99.9% probability that the Fed's not going to do anything, that the rates at the Fed meeting or after the Fed meeting next week are going to remain the same. So the market's pricing in no change whatsoever. And that's really interesting now because as I started at the top here, we saw the Bank of Canada, we saw the ECB lower rates over the last 2 days. Okay. Now, if we go out to the following meeting, which is July 31st, okay, we can see 83% probability that rates are going to stay the same, 16.5, 17% probability that there might be a cut of a quarter point. Very, very low probability. That's what the market's pricing in. However, if we then go ahead 2 months to the September meeting, that's where we start to see a significant change. So the probability that rates are going to be where we are right now after the September meeting drops to 31%, 31.7%. The market is pricing in. Again, when I say the market, I'm referring to where the bonds and where treasuries are trading live right now. So the market is pricing in a 58% probability that the Fed's going to cut rates by 25 basis points, by a quarter point. They're also pricing in very small probability, but a 10% probability that they're going to cut rates by 50 basis points or a half a point. So if we look at, the probability of a cut, regardless of whether it's 25 or 50 basis points, we're at about 68% probability. So that's what the market is pricing in. So right now with the weaker economic data we've been getting over the last, week, 2 weeks or so, those probabilities have increased a bit for what the Fed might do going out to September. Now, if we go to November, okay, not much of a shift. Not much of a shift here. The probability of rates being where we are right now dips down to 20%. So 80% probability that we're going to have a rate cut by then. But then if we go all the way out to December, last Fed meeting of the year, that raises the probability of rate cuts to 95% by then. So we've gone from coming into the year and the end of last year coming into this year with the market pricing in multiple cuts this year, 4, 5, 6, Fed cuts this year to now being 2 cuts. Well, it's pretty astounding to me that overall the market is trading near all-time highs. Yesterday the S&Ps closed at all-time high, the Nasdaq closed at all-time high. Dow week or two ago broke 40,000, was at an all-time high. That's pulled back a little bit. But given the landscape of how things traded last year and the anticipation of rates coming down, which everybody wants to see, to me, that's why we saw such a big market rally end of last year, beginning of this year. And now that those probabilities of 6 down to 2 have happened, but the market is still hanging in here. Man, oh man, this is it's crazy to me. It's crazy to me that the market is trading up here, and at the same time, the wall of worry is not really there with the VIX still trading really, really low at 12, 13 handle or so. Kim, great topic. I'll have to rewatch to get it in my head. I'm happy to discuss it with you in class, Kim, anytime. What should the play be for NVIDIA? Ronald, I'll talk about that in a second. Okay. Ronald also asks, is this a regular show? Can you catch us regularly? Tuesdays and Thursdays live from the floor here at noon Central Time, 1 o'clock Eastern Time. Okay, Tuesdays and Thursdays we will be here. Someone asked about tomorrow. When does the NFP non-farm payrolls come out tomorrow? 7:30 tomorrow morning, so an hour before the market opens up. Okay, okay. Let's turn to Nvidia here, guys. Everyone's favorite topic, right? Nvidia. It's like how the meme stocks were. GME, AMC, whatever. We've talked about this before, but let's talk about it again so everybody understands what's going to happen with Nvidia and the split. Okay? So right now Nvidia is $1,200 stock. Okay? At the close of the market tomorrow, that'll be the last time, at least till Nvidia maybe rallies again. That'll be the last time Nvidia is. Hang on, guys. Let's see what's going on here. So let me deviate here for a second and explain to everybody what's going on. I'm going to pan over there, actually. Okay, I don't know if you can see. I think so. There's some negotiation going on right now. Okay, broker had an order. I didn't hear what it was for, so the broker had an order. Whoops, hang on. You're on the. There we go. There we go. Sorry about that, guys. Now you can see the floor here and a trade probably about to happen. So the broker had an order. There we go. And I don't know what it was for, but the market that the traders or market makers responded to the broker was $1.60 bid offered at 170. So the broker has not responded yet. But if the broker wants to sell something, these guys are 160 bid. If he wants to buy something, they're 170 offer. What happens is this is a literal auction, live negotiated market. Most people don't understand that this still happens. Everybody thinks that, everything just trades electronically online. There's no faces behind who you're trading with. This is live market activity at its best. Now, the order's just sitting out there, so the broker is, maybe somewhere in the middle. Maybe he's 165 bid or offered at 165. When he comes back here, I will talk to everyone about what happens there. I'm going to pan back here, and then if we get back to a trade there, I will talk. Thank you, Mike. There we go. Let's get there we go. The SIBO likes to have that in the background there, and I don't blame them. So back to NVIDIA. Let's say the market closes. NVIDIA closes tomorrow, end of the day, 1200. This one's a pretty easy one. 10 to 1. Okay? So NVIDIA stock splits 10 for 1. Let's say you own 100 shares, which would be phenomenal if you own 100 shares at 1200 bucks. Come Monday morning, you're now going to own 1,000 shares at $120. No change in value whatsoever. There is no change. The only thing that changes is NVIDIA's open interest or outstanding amount of shares goes tenfold. Okay? Same thing with options. Let's say you own a 1,200 strike call option, 1. Okay? Come Monday, you're going to own 10 of the 120 strikes. Again, no change in the value of the position at all. Okay? What a stock split does is it obviously makes it easier for people that want to get into a particular stock. It's a lot easier to trade NVIDIA at 120 than it is at 1200. What it will also do is it should tighten up volatility quite a bit, because think of the amount of contracts out there right now, whether it's in the stock itself or in the option world. There's now 10 times the amount of contracts, okay, even though it's 1/10 the price. So it should consolidate the bid-ask spreads a little bit, even though NVIDIA is a real good trader in terms of bid-ask spread, and it should consolidate the movement, the daily movement in the stock as well, since there's now 10 times the amount of outstanding shares out there. Okay, someone was asking, where do we go back to here? Mike, what were they asking about?
Video play.
Oh, the NVIDIA play. So yes, Ronald, now that I talked about what happens with NVIDIA options, so what I just explained was we should see volatility start to shrink. So, regardless of what your take is on the stock, whether you think it's going to continue higher, whether it's going to go lower, whether it's going to stay the same, from an options perspective, I would want to be short volatility. I would want to be short time spreads, calendar spreads if I could, because history tells us, and it's not 100%, history tells us after the split, we're going to see that consolidation. We're going to see volatility come in. So that is definitely something that I would watch for. All right. We talked about ECB. We talked about Canada. They lowered rates. Switzerland lowered rates. I think it was about a month ago. Why hasn't the Fed lowered rates yet? Well, some of it may be a little stubbornness. Why do I say that? And I really say this with the most respect for Jay Powell and the rest of the Fed heads, because these are really smart people, really, really smart people. But they've kind of boxed themselves into a corner, with the raising rates, raising rates, raising rates. Here we are. Inflation's not 10% anymore. It's not where it wants to be at 2%, but we're on our way there. So they're still waiting to make sure that they see the economy slowing down, they see the labor market slowing down satisfactorily enough, if that's a word, where they can start easing. Because again, what is easing? What is lowering rates going to do? It's going to make it easier or more attractive for people to borrow money and spend money. So what they want to do is, what they don't want to do is lower rates too quickly and then just spur on inflation again. It's a really delicate balance. It really is. It's definitely not easy at all, and that's why it's a wait and see. It really is a wait and see. All right, guys, I really appreciate this. We're going to wrap this up in a couple minutes here. They actually have a lot of guests coming down to the floor today, being the day that it is D-Day. They have a lot of veterans coming down to the floor today. Some World War II vets. It's going to be really cool. I can't wait to be down here on the close. They're going to hang on. They're going to actually be ringing the closing bell later. Okay, 6090. Let me pan over here again, guys. Let me pan over because we might see something happen here. So you see guys looking down at their handheld computers, 6090, 6090, waiting for the broker to respond to that. Don't know if they will or not. I'll keep that on there for a minute here. But what I wanted to tell everybody is that we are having a webinar tonight. I'm having a webinar tonight, actually. Um, There we go. Oh, look at that. Look at that. Let's go. Let's go. All right. When I used to trade in the pit here, guys, by the way, I know I'm all over the place. When I used to trade in this pit for Goldman Sachs, the S&P 500 pit, it wasn't as cozy and cushy as it is right now, everybody with their workstations. We were literally sandwiched together, just side by side, shoulder to shoulder, and it was a dogfight. It could definitely be a dogfight. What I wanted to tell everybody, and Mike, if you can put up that link there. I am doing a live webinar tonight. Yes, it's live. It's not recorded. They're always live. I always get that question. Is this live or is it recorded? Tell me what's going on. Well, tonight I'll tell you what the Cubs and the Reds are doing. I'll tell you what the Mavericks and the Celtics are doing. A new product that I am launching called Market Maker Moves. Okay. And it is a new signal service that is going to be focused on really basic option spreads, mostly vertical spreads. It's not going to get into the weeds of what we do in our other classes. We're not going to have any sort of exotic type of positions that we, have sometimes. This is going to be a very new program, signals, okay? And I'm going to show you what we're going to do. I'm going to show you why we're going to do it and really focus on the probabilities of trading. So that's tonight, guys. I think the link is up on the screen here. If you're interested, please go ahead and click that. And I really, really would appreciate if you're on YouTube. I don't know if you can do it on Twitter or X, whatever they call it, or on Facebook, if you can hit the like button. But if you can hit the like on YouTube and subscribe, that would be just Awesome. Dennis, it's at 7 o'clock Central Time tonight. 7 o'clock Central, probably about an hour and a half or so. Okay. So again, here we are. It's 12:30. Last wrap up here. S&Ps are now down 5 points, so they've rallied about 7 points while we've been talking here. Again, volume is still incredibly, incredibly light. I wish I could do this tomorrow morning at the opening of the market because I have a feeling that there might be some fireworks tomorrow morning after the NFP announcement. So, guys, I really appreciate it. We'll take any suggestions you have. We'll take any comments, any questions, any criticisms you have. You think, I'm not doing something that you want to see? Let us know. I'm a big boy. Let us know. We want to make this the information that you want to get. Okay, and I love doing this because being down here in the pits, this is my bread and butter. So, guys, I wish everybody a wonderful, wonderful evening. Great rest of the trading day, and we'll see you on Minds of Markets live again very, very soon.